Good morning, everyone. Thank you, all investors, for joining into another bond issue webinar organized by Orion Securities. Today, we'd like to present a second offer of Lithuanian Central Credit Union, or Lietuvos Centrinė Kredito Unija in Lithuanian. During the second tranche of the issue, the issue will try to raise up to 4 million euros of subordinated bonds to expand their Tier 2 capital and expand their further loan portfolio. For today's webinar, we have Vytenis Šukevičius, who is Head of Treasury and Deputy CEO.
Hello.
At the LCCU, and me, Matas Šipkus, Orion Securities representative. Yes, sure. So let's start with a short transaction overview. This current second tranche is a part of a larger bond program up to 8 million euros. The first tranche was issued during December of last year. There was a slight oversubscription of 5.5 million euros, but the issuer decided to issue only the 4 million euros. So the current tranche is a tap issue of a larger bond program. The status of the bond, as I mentioned, is unsecured and subordinated bonds. So the risks are a little bit higher with this bond compared to rather common bonds in the market. The term is 9.5 years, or we could say 10 years from the initial offering of the first tranche. The term could be seen as quite long. However, it is quite common to issue 10-year bonds for financial institutions in the Baltics, especially subordinated bonds. For the current tranche, the interest rate is 8.25%, and interest payments are semi-annual. And I forgot to mention everyone that during the whole webinar, everyone can ask their questions in the Q&A section of their Zoom website. And I just want to remind everyone that this is a public issue, so everyone from Lithuania, Latvia, and Estonia can participate in this issue, especially from the financial intermediaries in Latvia and in Estonia. So a short glance at the issuer. Vytenis will expand more on the whole operation and financial side of the issuer, but LCCU, or Lietuvos Centrinė Credit Union, is the largest credit union in Lithuania. It unites more than 44 member credit unions across the whole Lithuania. As other banks and credit unions, the issuer and its members are supervised by Bank of Lithuania, and its services could be split into two parts. First would be centralized financial and operational services for its member unions, and the whole group oversight and risk management of the credit unions, working consolidating basically the whole group, and maybe we could say working as a sort of mini central bank for its members. A short glance at a key financial metrics. Firstly, I would like to mention the group loan portfolio, which expanded to 983 million euros during the first quarter of 2026. I would like to also mention that I guess the whole portfolio is split quite evenly between natural persons and legal entities. Furthermore, we'd just like to mention that the whole group's equity and reserves expanded to more than 100 million euros during 2025 and expanded even further during the first quarter of 2026 to 105 billion euros. So the full terms and conditions of the bond issue, as I mentioned before, the issue type is Tier 2 subordinated note, so a little bit riskier bond compared to common bonds in the market. With the use of proceeds from the bond issue, the issuer intends to strengthen its Tier 2 capital to further expand its loan portfolio and increase interest revenue. The second tranche is a part of the larger 8 billion bond program, but during this tranche, the issuer will issue up to 4 million euros. The interest rate is 8.25%. The subscription period will go until 26th of June, and the issue date is projected on 30th of June. The interest payments are semi-annual, and then mentioned before, the term is 9.5 years with the maturity on 17th of December of 2035. A long term, but quite common for financial institutions issuing subordinated bonds. What we'd like to mention, the early redemption option. The issuer can exercise this option 5 years before the maturity of the bond, or 4.5 years from the issue date of this current second tranche. Yes, and the value of the bond for this tranche is 1,002.93 euros. Those 2.93 euros are basically accrued interest from the previous interest payment date. So also I'd like to mention the key dates of the whole bond. So the issue has started on June 11th, so last Thursday, and will go up to 26th of June, with planned issue date on the 30th of June. The semi-annual interest payments are every year on December 17th and June 17th. The early redemption possibility sort of unlocks on December 17th of 2030. And it's also very important to notice that that the issuer must get an approval from Bank of Lithuania to exercise this early redemption possibility. And of course, the maturity date is on 17th of December of 2035. So almost 10 years from the issue date of this current tranche. So before giving floor to Rūtenis, I would like to say just some key investment highlights that we see. So the issuer is Lithuanian Central Credit Union. It's the oldest credit union in Lithuania and unites 44 members. 44 members across Lithuania. It's almost very important to mention that under current regulatory framework, the additional central credit union would be very complicated to establish. So just to mention that the exact competition, new competition, would be very difficult to establish, and there's just very limited possibility for that to happen. Furthermore, as all banks in the Baltics, same with the issuer and its member unions, it is supervised by the central bank. They ensure compliance with strict capital, liquidity, and risk management standards. Then, as mentioned before, a strong and stable balance sheet. The group reached 1.27 billion euros of consolidated assets during the first quarter of 2026, and its capital adequacy ratio was above 13%. And lastly, the group is financed by
Not capital adequacy, but it's CET1.
Okay, yeah, sorry, CET1 ratio was above 13%. And lastly, the group is financed by multilateral development institutions, such as European Investment Fund and Council of European Development Bank. So now up to the group overview. Yeah.
Okay, thank you, Matas. Hello, everyone, once again. So basically, Matas gave a good introduction of what are we trying to achieve here. So it's to issue a second tranche of subordinated bond. I will concentrate more on who we are as an issuer, why are we doing what we are doing, and why it is worth investing into subordinate bonds by Lithuanian Central Credit Union. So very briefly, the credit union evolution in Lithuania can be kind of split in two parts. One is before 2018, another one is after 2018. Before 2018, it was a pretty loose system. The credit unions could be members of Central Credit Union, or they could be like so-called independent credit unions. The regulation was not that strict and things like that. But as of 2018, it has all changed. It was because central bank and politicians agreed that we need to foster kind of Lithuanian capital growth in the banking sector because, surprise, surprise, the Baltic market is kind of dominated by Scandinavian banks. So we wanted some kind of local answer, and they saw that as it is, the system would just die in competition. So they said, okay, you will play by the same rules as other banks in the financial ecosystem, and basically introduce stricter capital governance and prudential standards. So the Central Credit Union and the group on consolidated level now is governed by CRR. So basically all the same requirements as for any commercial bank. And as a result of this, two Central Credit Union groups are now in Lithuania. So we are the original one, which was also even before the reform. So the ones who wanted, they wanted. So we are like on a willingness and cooperation base. The other Central Credit Union is comprised more of those members who were not willing to be in a Central Credit Union before, but as a law obliged, so we had to do something. So overall, it's 58 credit unions, 44 are our members, and on asset size, we are like 2 times bigger than the other Central Credit Union group. Okay, so if you can see, we have physical presence all over the Lithuania, all over the country, and it is one of the aspects of our strategy because traditional banks exited the rural areas. Progressive, innovative, fintech, unicorn banks, they don't want to go to rural areas. So this is basically our niche, which we are exploiting quite successfully in the recent years. And we feel that there is a segment of people who value that they can come any time of the day, just passing by during lunch break, like it used to be with banks, but not anymore. You have to register 2 weeks in advance. They value that they don't have to go 40, 50 kilometers to some regional center where there is a bank branch. So they value that it's close and it's convenient. So it comes at a certain cost because keeping physical premises, keeping employees, it has its own cost. But for now, at least, the benefits we see are bigger. Our headquarters is in Kaunas because historically credit unions started from farmers, and all the good farming lands are from Kaunas up north to the Latvian border, basically. So it was picked as a center, which is convenient for everyone. On group level, it's almost 600 employees. We are audited by the Big Four company. Every individual credit union and central credit union as well, we are members of deposit insurance. And on top of that, we have stabilization fund, which is a key element of cross-guarantee system, which I will elaborate a bit more towards the end of the presentation. And basically, we try to be a center of competence for cooperative banking and be close partner to local communities and enable their growth. Yes. So, what do we do? Sometimes we get the question, what is the difference from the bank? So basically, on a services offered level, we are offering 90% of the services, daily banking services, retail banking, corporate banking, payment services as any bank. Just that we do not offer investment services. And historically, we slice our customer portfolio into three segments, not private persons and corporate entities, but also farmers. Because for the farm credit unions, as I mentioned, started from farmers, and they are important part of our portfolio. They are quite often in management in rural credit unions. So basically, it's our, again, one of our specifics. So we have 44 member credit unions. They keep relationships with the customers. We try to sell loans, collect deposits, sell credit cards, and satisfy any other financing needs. Then we are on top of our member credit unions. We are a central body, and we have like dual role. First, they want it or not, we are the supervising body for them. So it's like a first line of defense before Central Bank of Lithuania comes running and saying something is wrong. And this means that almost all internal documentation, especially which is related to risk scoring, risk management, risk mitigation, is prepared centrally in Lithuanian Central Credit Union, and member unions have an obligation to adopt it and work adhering to the principles set by Lithuanian Central Credit Union. So this is one big plus for our system, that basically the risk management process is unified. And we know what each member knows what to expect from another member, so that there will be no, I don't know, experiments or very bold moves. So everybody has the same rules of the game. Second aspect is that it's natural that for credit union in a smaller city, sometimes it's complicated to find competent chief accountant, competent AML specialist, competent internal auditor, competent risk management specialist. So we encourage, and the credit unions have been quite actively increasing in numbers on that one. We encourage the centralized services for that. So meaning that the credit union doesn't need to have a chief accountant or anti-money laundering specialist. A specialist which works in central credit union does that for them. So this again is another important aspect. It means that we always keep our fingers on the pulse. We know what credit unions are doing, what they are up to. We even have this so-called distant monitoring system, because we have our own single core IT system, so our supervision department at any moment can see how a individual credit union is doing. So again, it gives transparency, it gives security, and it gives short reaction times in case there is some problem. We can see it on our own, and there's no way credit union could hide something from us and things like that. Yeah. So how did we get to what we have now? So very briefly, as I said, 2018 was a pivotal point of credit union reform. Credit unions started popping up in the last decade of the last century, like 1994, 1995, 1997. In the beginning of this millennium, they recognized the need for central credit union, but up to 2018, it was, up to 2016, it was a loosely regulated, mutual beneficial type of credit institution sector. But in 2016, Bank of Lithuania with politicians said we need to do something. We gave 2 years transitionary period, and from 2018, the credit union sector is completely different, governed by CRR, audited by Big Four companies, growing each year, and now, the total credit union sector in Lithuania is about 2 billion euros. 1.3 billion euros are as Lithuanian Central Credit Union. And just to emphasize that in the end of 2025, we already issued 4 million because it's what we needed at the moment, at that time. Now the loan portfolio has grown. It has grown a little bit faster than we projected. So we are coming back with another part of 4 million because we have a program of 8 million. Okay, yes. So this is maybe worth spending a bit more time. So this is the loan portfolio overview of the group, because basically everybody evaluates us as a group, basically, be it European Investment Fund doing its due diligence process, being it some participation in some EU-sponsored programs, when we are financial intermediaries for disbursing funds to small and medium enterprises. Because we can only go down as a group. I will again explain it towards the very end of the presentation, but basically this is the loan portfolio of the group. And as you see, 520 million out of 980 million are loans to natural persons. Very roughly, almost 400 million of those 520 are mortgages. So secured by real estate, issued in line with responsible lending principles, which are set up by Bank of Lithuania and collateralized and things like that. 100 something would be farmers as private farmers, because farmers can be private or we can kind of organize to some farming entities. So these are like private farmers. And about 25 million is consumer credit, which is basically unsecured. So same picture with corporate lending, because we try to lend always with the collateral, be it farming land, being some kind of working premises or agricultural premises or even agricultural equipment. So I'd say 85, roughly, maybe up to 90% of our portfolio is collateralized. We always try to issue a loan with collateral, maybe even a bit more than 90%. So, which means that 80% of our loans are rated as low or very low risk. This is the methodology by assigning the loan to risk group, and depending on that, it's capital requirement, provision probabilities, and things like that. So 80%, almost 80% are very low or low risk. And it's also reflected in our provisions ratio. So provisions to portfolio is 1.9%. It's a bit higher than in big commercial banks, traditional banks, but still it's at very adequate and decent levels. Yes, again, where is our place in this financial ecosystem? So we do not compete with banks like Swedbank, SEB, or Luminor. We are a bit more expensive than Arteria, maybe a bit more, but on the less scale, a bit more expensive than Urbo. We are usually less expensive than the specialized non-credit institutions who lend to small and medium enterprises. We are cheaper than those peer-to-peer funding platforms, but they are mostly doing real estate financing. But at some projects we do get competition from them, but we are cheaper. So we are somewhere at the level of the specialized banks, which are now kind of popular topic in Lithuania. So this is where we find our place. Of course, consumer loans are priced the highest, and in general, the chart reflects the logic that consumer interest rates were going down for the last couple of years. Now, as monetary policy has shifted and the new Euribor started going up, so there might be some adjustments to the loan rates upwards. Yes, and what I would like also to emphasize is how well are we funded, because Lithuanian Central Credit Union has an obligation by law to ensure the solvency and the liquidity of the whole system. So we need to have quite decent chunk of liquid assets. And the logic is that the credit unions gather deposits and current accounts from their members. And the surplus, which we do not lend out or invest somewhere, they have to keep in Lithuanian Central Credit Union, which is mandatory requirement. And then Lithuanian Central Credit Union decides what to do with this extra surplus. So as a Central Credit Union, we are recognized eligible counterparty for Bank of Lithuania, so we can just keep the money in the account of Bank of Lithuania, or what we often do, we invest into government bonds. I will come back a bit later on that, what type of bonds we usually buy and what do we do. But as you see, the absolute majority of deposits come from private persons, and I'd say 95% of those deposits from private persons, they are below 100,000, so means they are insured by deposit insurance, meaning if there is a rumor in local newspapers, so nobody will come running at the door of the credit union, because deposit insurance now pays out money in like 5 or 7 days. And another good thing is that we have lots of small deposits, so our funding base is very well diversified. So we don't have very big deposits, rather we have a lot of small ones. So again, this is stability, and this is very beneficial to our funding base, which is basically also reflected in deposit interest rates. If you see, we pay quite comparable rates to commercial bank, to even to big commercial banks, and lower compared to some specialized banks or internet banks. And this is for Q1, so Q2 statistics will be maybe a bit higher again, will be like 2.4, 2.5. It's started going up a little bit, but we are not paying like 5%, nowhere near that. Yeah, And these are the key indicators for the group. As I mentioned, like everyone looks at us as a group. So we have to comply with capital adequacy. So group level minimum requirement 13.4, actual 16. On solo basis of LCCU, the situation is even better. So requirement is around 14 and the actual is close to 19. So meaning that we do prudent planning, we look in advance, we don't come to the markets to issue subordinated bond in the last minute that, okay, now we are on fire. So at the moment, we could still go maybe for 6 or 9 months without it, but we see portfolio growth. If we get some maybe small surprises in growth as we got in the Q1, maybe it shortens from 9 to 6 months. So we are trying to do it like in a proper way. So liquidity coverage ratios, it's almost twice higher, more than 2 times higher than minimum requirement. So it's basically related to the fact that we keep a lot of money in high quality liquid assets, meaning Eurozone government debt securities, mostly rated A- or better. So on the group level, we have around 230 million portfolio of these government securities. More than 200 million, or okay, roughly let's say 200 million are this high quality liquid assets, which can be sold quite fast without incurring major additional charges. And they are also eligible for pledging to Bank of Lithuania, which we do from time to time because it's kind of required by all those business consistency plans. So you should test at least twice a year. Does your system work and can you actually borrow money from central bank and things like that. And the largest exposure to one borrower, so it's a max loan requirement. So I would like to mention here that it's not for a private person, not for a corporate entity. Because on that side, so maximum, the biggest loan doesn't comprise 1% of capital. Top 5 loans are somewhere around 4 for something. Top 10 loans are 7 plus minus. This is the position of government bonds because not all Eurozone members have euro. So this is one of the Eurozone members which has not euro yet. So for liquidity purposes, these are euro bonds denominated in euros, but their national currency is not euro yet. So for liquidity purposes, those bonds are perfectly fine. For capital adequacy, for maximum loan calculations, they are treated a little bit different. So this is not some company, not some private individual. This is one of the governments of Eurozone. Yes, so organizational structure, very briefly, basically experienced people in the management. Most of them have quite extensive experience in banking or one of the biggest audit companies. So we feel like we know what we are doing and where we want to go. So and so far it has been quite successful. So this is also one of the aspects to consider while making decision to invest in LCCU subordinated bonds. Okay. Yes, and this is the cross guarantee aspect. I said I would like to touch more extensively. So basically, this is our organizational structure. This 124,000 private individuals, 600 corporate entities. They are members and owners of credit unions. Because in credit union, the principle is one member, one vote. So the credit union has no major shareholder. The 44 member unions, together with government of Lithuania, they own the LCCU, Lithuanian Central Credit Union. And on the right, you see cross-guarantee system. Basically, we have a stabilization fund, which is required by law and which has to be at least 1% from total assets of the group by 2028. And we are basically ahead of schedule. We will be there this year or early next year. And it is comprised of 2 types of contributions. So every member credit union regularly pays the so-called ex-ante payment. So we know that each quarter they pay a certain fraction from their total assets. It's like 0.18, 0.2. And this stabilization fund grows over time. Should there be a bigger problem and the stabilization fund would not be enough to save the failing credit union or several credit unions, it means that all other remaining members, they have an obligation to chip in, so-called like ex-post contributions. So they need to chip in to accumulate the amount which is needed to solve the problem or bail out or how you call it. So this is an important aspect because basically we are members of deposit insurance as well. So if there is a Lithuanian-wide problem, so it's the deposit insurance, we will bail out the depositors. If there is a problem of a smaller scale, it might be even that the stabilization fund will be enough, and we can only go down as a whole system. It cannot be that 42 credit unions are doing fine and 2 are in the process of bankruptcy. So this basically cannot happen because the 42 have an obligation to save those 2. It can be, depending on what the problem is, it can be liquidity injection, it can be capital injection, it can actually be even a merger so that they merge the failing credit union to be a bigger one. But this is, I believe, a very important aspect when assessing our financial stability as a group and when taking a decision to invest into LCCU subordinated bonds. Okay, so financial information, I won't be long here. So basically the idea is that this is consolidated levels. So we have been working profitably for the last 3, well, even for more years, but like, let's say these are 3 last years. So we are doing okay. And this year seems to be good as well. As I mentioned, the loan portfolio growth surprised a little bit to the upside. So one of the explanations why Q1 is better than Q1 a year before. And here, just to highlight the growth of total assets of the group. So we are now 1.27 billion. And on the left-hand side, like in the middle of the table, there is securities. So you can see that group-wise, we have 232 million. So 2 million plus a little bit more. It's like the so-called HQLA. So securities which are high credit rating, we are eligible to pledging for central bank, and they can be sold in case of necessity quite fast. And this is on standalone basis. So again, the results are fine, and this year is gonna be a better year than the last one. And also on the left-hand side, middle securities. So you see that out of 232 million of securities, 195 million are held by LCCU alone. So this reflects that we are the liquidity management center of the whole group, and that credit unions, some of them have some government securities, but Bank of Lithuania has issued a special decree limiting where credit unions can invest. And basically, it's not their field. Like several credit unions in bigger cities do that, but in rural areas, they're very rarely. But this is just to reflect that liquidity is managed centrally, capital adequacy is managed centrally, and the size of LCCU as a central body has surpassed 400 million in quarter one of 2026.
Right. So yeah, thank you, Rutanis, for the presentation of the company and its financials. Before moving on to the Q&A section, we would like to briefly discuss the risk factors. As with every investment opportunity, all investors must understand the risks associated with the investment opportunity. Here in the slide, we only have the summary of the risks associated with the company, with the bonds itself. You can find the full descriptions of these risk factors in the information document of the issue, and advise everyone to get to know those risks if you think of investing in these bonds. Yeah, but before moving on, I would just like to expand on a few of the risks that I think need to be discussed. Firstly, and as always, I think credit risk is very important, as the group and the issuer is the lender, so deterioration in the creditworthiness of borrowers and counterparties could result in increased loan losses or impairments. Then, of course, as every business, the issuer and the group is subject to market and economic risks. Basically, yeah. So, even as always, the market and the economy itself has different stages. So, in the economic downturn, the issuer could result in some significant losses. However, as we mentioned before, any capital buffers are in place for this not to happen. Then I think it's very important to mention basically the bonds risk, as it was mentioned. These bonds are tier 2 subordinated bonds. They are of much higher risk than regular bonds you see in the market. With subordinated bonds, basically the investors are only in front of the equity holders in the case of any bankruptcy or default procedures. So yeah, every investor must think of these risks, if these risks are okay with them before investing. And the last risk I would like to mention is basically risk of inactivity in the secondary market. This issue is already issued in the Nasdaq First North market. However, the issuer does not provide any market making activities. So every investor that decides to sell or buy the bonds on the secondary market must be aware that the liquidity might not be big enough for them to sell or buy at the wanted price of the bond. So yeah, moving on to the questions. First question would be, if the economic environment weakens, which part of the loan book would you expect to be the most sensitive?
So if I understand that economic environment weakens, so meaning that, let's say, economic growth stalls, maybe job market gets a little bit weaker. So I think that the most stable would be the mortgage part, because it happens that we don't have like a lot of investors into real estate. We basically have first-time buyers, which will do anything to keep their apartment or their house. So I expect this to remain the most stable. Well, if there is a downturn, so I guess real estate market would experience that. So we do finance some real estate development, but it's not like major products. But we do finance some related areas like timber manufacturers, some kind of furniture manufacturing, which kind of goes into the full cycle with real estate. So this part should weaken. Farming, I'd say, would stay okay because it kind of from history, it's obviously that people have to eat. So
Yeah.
so this is quite stable. So yeah, some what else? Yeah, so maybe the business portfolio part, if even especially if it has some kind of references with real estate, with this, that. So that I would see.
Okay. Yeah. What specific risk would management identify as the biggest threat to the bondholders? Credit risk, liquidity risk, refinancing risk, or subordination risk?
Credit, liquidity.
Financing or subordination?
Well, I guess as a we don't plan, let's say, to default anytime soon. So from credit risk and from subordination risk, at least at the moment, everything looks quite fine. I guess the issue could be liquidity, as you mentioned, because if there is no guarantee that we will redeem it in 5 years, so it can go for 10.
Yeah.
So we have a right, but not an obligation. And in case you want to exit, you might not be able to find the buyer or the buyer at the right price or the buyer at the right time.
Yeah. Okay, so next question. Under what exact capital, liquidity, or market conditions would the issuer choose to use the call option?
Okay, so basically, the logic is that, okay, the bond is 10 years. So for first 5 years, everything is fine. 100% of the bond is counted as capital.
Yeah.
End of year 6, only 80% of the bond is counted as capital. End of year 7, only 60% of the bond is counted as capital. So basically, with each year, 20% is eliminated. So from the issuer point of view, it makes the most sense to buy redeem after 5 years and issue a new bond. So do the refinancing, and this is usually the case, and we kind of think that it's a pretty big possibility that it will be the case. It can happen that, okay, it might make sense to keep it for year 6, but for year 7, it becomes very expensive for the issuer.
Yeah.
So one situation where we could decide to keep it to maturity no matter what, if in 5 years the general interest rates are very high. Let's say deposit rates are 7%.
Yeah.
So for us, when it's basically we can have it like not part of capital and part of just like liquidity. So this is one scenario where we could decide to keep them. The other aspect is that we need Bank of Lithuania approval for that. So if during those 5 years we do something very, very bad and we make loss and our capital doesn't grow from profits, because I didn't mention in the presentation, we don't pay out any dividends. So 100% of profits are allocated to capital base. So it's like, as you have seen, like 10-11 million yearly in the past few years. So if we do something very wrong on that side, then the Bank of Lithuania might say, okay, if you redeem those bonds, you won't be fulfilling the capital adequacy requirement. So, and we cannot, let's say, find any investors for refinancing because we see that we are doing poorly. And at that point, we might say, okay, we don't buy it after 5 years because Bank of Lithuania didn't allow us, and we go.
Yeah. until the maturity.
Yeah, we can try maybe then at 7,
Yeah, of course.
at 9, but yeah, we can go to maturity.
Yeah. Okay, so next question, how sensitive are the issuers' net interest income to changes in the Euribor?
Well, if you need like specific figures based on the model, so I would need to come back later on that. But basically, the general logic is that when interest rate increases as it is now, so the income from loans increases faster because loans reprice faster. They reprice in 3 or 6 months. And the most popular deposits maturity is 12 months. So also quite a portion of between 12 and 24 months. So meaning that the bulk of the deposit base reprices with some lag. So when interest rates are going up, in the beginning, the like margin widens and interest income increases. If there is a reverse tendency, the interest rates are going down, then the tendency is, of course, that the loan income goes down faster than the expenses you have to pay for deposits.
Okay. Yeah, there was a question regarding the use of proceeds of the first tranche. So where did you use the proceeds, and was it originally planned that you would come back to the market so soon?
Yeah, so soon is half a year.
Yeah.
Half a year. So we basically thought about now or maybe beginning of September when everybody comes to the market, because July, August usually slow. June is maybe also not the best one, but we know from experience that in September everybody comes to the market and tries to issue. So we decided, okay, we do it a little bit earlier. So I got a similar question when doing the first tranche. So very roughly, 4 million into capital enables us to issue for 40 million of new loans. So if you saw, we achieved 43 million loan portfolio growth in Q1 alone. So meaning that now it's almost end of Q2, so the growth is even bigger. So basically, all the 4 million of the first tranche were used as we said, basically to increase capital base so that we would be able to grow our loan portfolio and increase interest income.
Okay. Yeah, next questions. How do you see the competition in the market for both deposits and loans? Is it stable or increasing? Do you face any new players?
Well, you saw our rates for loans and for deposits. So judging from deposit rate, so you can make a conclusion that it's not very competitive because we don't have to pay very high. So the new players, like specialized banks, which set up in Lithuania, so they usually go to platforms like Raisin, and they get big part of their funding there. So they are not kind of trying to get their funding from local sources at any cost. So in deposits, not really. In loans, yeah, we do have some competition, and I mentioned that in 98% of the cases we cannot compete with, let's say, SEB or Swedbank or Luminor or Revolut. There are sometimes cases like that, but we kind of think of them that, okay, it's a little bit of luck, but not a regular business. So from loan side, well, we have one big advantage in the regions of Lithuania. So the banks don't really want to go there very actively and be present. So in this part, we don't really feel a big competition because let's take a mortgage. Okay, you can get a mortgage in a big bank at Euribor plus 1.5. You can get a mortgage in a credit union in a small town at Euribor plus 3 or plus 3.5. So like twice the margin. But when you take into account that the apartment in a small town costs like 30 or 40,000 euros, so the potential borrower has half of the amount, so it doesn't really make difference for him if he has to borrow the remaining 20,000 at plus 1.5 or at plus 3.5, because he values that it's fast, he knows he will get, he doesn't have to go 50, 40 kilometers somewhere to the regional center, and there is not the competition. In terms of farming, well, yeah, recently there is a kind of, for a very long time, banks didn't know what to do with farmers. Is it a private individual? Is it a corporate entity? They didn't want to take farming land as collateral because what to do with it in case of default, and then you have to repossess and things like that. Now we have increased somewhat the efforts, stepped up the efforts to service the agricultural sector. But here our long history and even the farmers in rural areas, bigger farmers, they are members of credit unions, they are sometimes even members of management boards and things like that. So, the networking and all things, it helps us to withstand this competition quite successfully. So I guess the biggest competition is for credit unions in bigger cities, because you have specialized banks, you have crowdfunding platforms. Okay, they mostly deal with real estate financing, but sometimes we encounter them. You have like non-bank lenders claiming that we are financing medium and small enterprises, which is the European definition of small and medium enterprise, means like, I guess, 80% of enterprises in the Baltics. So yeah, in bigger cities, the competition we feel is increasing somewhat.
Okay. Yeah, and the last questions, you mentioned already that the dividends are not paid to the members. So we have follow-up questions if the owners or members get any returns if dividends are not paid.
At the moment, the broader answer is no. We are now in the process of introducing preferred shares. So the owners of the preferred shares would get kind of some payout, which would be higher than deposit. So let's say if deposit is 3%, so if you own a preferred share, you would get 6%, something like that.
But still in process.
Yes, it's still in process. So basically, it's not kind of the philosophy of start of the credit union. It was not driven by some return on equity consideration. It was more or less like mutually beneficial lending and then saving. Of course, it is changing with time, and we, like, as a group, we are becoming a modern progressive financial institution group, but the law says that we can only pay out 10% in dividends. So basically nobody wants to bother with that, because it would be very small amounts. So we need capital to grow, so we put all our profits into reserve capital.
Yeah. Okay, thank you. So yeah, this is the end of the Q&A section. And before we end the whole webinar, I would like to remind everyone that as this is a public offering, every investor from the Baltics can participate through their financial intermediaries, either in Latvia, Estonia, or in Lithuania. The subscription period will go up to will end at on June 26th of June, and the issue date is planned on 30th of June. So yeah, the term is 9.5 years, and as it was mentioned, every investor will receive 8.25% of interest rate who participate in the issue. So yeah, thank you, Vytenis, for the presentations. Thank you, everyone. Thank you, everyone, for joining in, and have a great day.
Yeah, thanks. Bye.